Hi, this is Francesco Nagari, Deloitte Global IFRS Insurance Leader. Welcome to our IFRS Insurance webcast. Today, the title of the webcast is the IASB completes its second round of IFRS 17 amendments. Major fixes on profit recognition principles approved. The agenda for the webcast today is structured as usual against three items. First, I'll give you the highlights of the IASB meeting on the 23rd of January last week. Then we'll spend the majority of the time together going through a detailed analysis of the IASB discussion and of the decisions reached. And then I'll spend several minutes. There is quite a lot to talk about in terms of the next steps from now. In terms of the highlights, the IASB has continued the analysis of the 25 concerns that were identified for potential amendment at its October meeting. That is also the meeting when they approved unanimously the criteria for assessing each of these concerns and determine whether an amendment would be appropriate. The set of agenda papers that were tabled and debated for this past meeting covered 5 concerns, and 4 have resulted in an approved amendment. A far greater proportion of concerns resulting in an amendment than the one that I reported back to you in the webcast for the December meeting. The IASB has rectified the requirements for profit recognition in the event of an insurance contract providing the policyholder with both insurance and other non-insurance services, particularly those that relate to an investment management activity. The IASB has now approved that both services must be considered in IFRS profit recognition through the CSM. The IASB has also amended the application of the pre-coverage cash flow, acquisition cash flows, allowing the deferral of acquisition costs incurred with the expectation of future contract renewals, fixing again another profit recognition problem that was highlighted particularly in the general insurance sector when commissions for the anticipation of renewals were paid without a right for refund to intermediaries. And also reinsurance from a cedent accounting perspective has been rectified in a few areas. The most important one is the mismatch between reinsurance recoveries recognition through P&L and the recognition of onerous losses for reinsured issued contracts. Another amendment that has been approved, which is the 4th one, is the allowance of reinsurance contracts held to be used as a hedging instrument for VFA hedge accounting. The one concern that was not producing an amendment was the concern about reinsurance being outside of the VFA accounting. That has been confirmed as the intention of the IASB, so they will continue to not be accounted under VFA. 4 out of the remaining 6 concerns at this point will be covered in the IASB meeting in February, next week, in fact, on Thursday. As of today, 3 of those have been highlighted by the IASB staff as concerns where valid amendments could be passed, so we'll see next Thursday whether that proposal will be approved by the IASB. After that meeting, if the concerns are dealt with, that are tabled for discussion, there will be only 2 remaining concerns. Number 2 on level of aggregation and number 25 on transition when the fair value approach is adopted and the transition treatment for OCI on related financial assets. Let's now go through the detailed arguments put through the IASB staff papers and the discussion on the first of the concerns that was debated last week, the one on contractual service margin and the definition of coverage units in the general model. We probably remember from reading the IASB papers, but also through our Deloitte webcast, that in the June meeting of 2018, the board had already tentatively decided to clarify that the determination of coverage units should be done by considering both insurance coverage and investment-related services for insurance contracts accounted for with the variable fee approach. That decision created then a bright line, effectively a cliff effect between those contracts that would qualify for the VFA and those contracts that, although we're not direct participating contracts, they also provide investment-related services or other services that would be excluded from the determination of the coverage unit and therefore the CSM allocation accounting process. The CSM is determined by taking into account all of the expected cash flows irrespective of what service they are being paid for by the policyholder. The effect of then allocating it back to P&L using a particular driver only, when you have multiple benefits that are non-insurance in nature, could create some problems in terms of the profit pattern. And these could have produced unintended consequences if it had been maintained in the standard. Unintended consequences such as a front loading of the profit recognition if the insurance coverage is shorter than the coverage for other services in the contract, or backloading if the opposite is true. The IASB staff paper correctly analyzed the universe of insurance contracts in the two subcomponents, the ones with direct participating features and the ones without direct participating features. The latter are those contracts where the entity provides a return that reflects the uncertainty of the cash flows to be repaid to the policyholders, just like any other financial liability, but without having the direct linkage to a specified pool of the underlying items that the customer, the policyholder, is aware of. There is an acknowledgement in the paper that no useful information is provided for contracts that have an insurance coverage period that differs from the period in which the policyholder gets return on an investment component if the total profit is recognized over only the insurance coverage period. And so the staff proposed to introduce a new concept, the investment return service, which is providing the policyholder with access to an investment return that would not otherwise be available to the policyholder. In other words, instead of managing assets on behalf of the policyholders. With that in mind, the staff recommended to the IASB to amend IFRS 17 so that the general model, the CSM, is allocated on the basis of coverage units that are determined by considering both insurance coverage and investment return service. And they asked the IASB if they agree with that. So there was an interesting discussion here, and I pick a few points which I believe are important. The first point is the analysis of these recommendation against different dimensions, which I've summarized in this diagram here. There are 5 of them. The first one is the circumstances in which the investment return service exists. And the staff analyzed that particular point, noting that the investment return service can exist only when an insurance contract includes an investment component. There has to be an element of the cash flow which is a return of premium and therefore a financial saving element for the customer. To require an entity to use judgment and to apply consistently in deciding whether to include an investment return service when determining the coverage unit would be the preferred route that the IASB staff suggested should be taken in the standard. Also because the period of investment return service is regarded as ending when the investment component payments are made in full without taking into account the payments to future policyholders. And that is to differentiate one of the characteristics of the participating business measurement, which looks at the obligation from the insurer to pay cash flows out of the underlying items, also in view of future policyholders. The second dimension that the staff noted is the subjectivity in weighting of services. They thought about developing further guidance in IFRS 17 on how to make the relative weighting assessment, but that was not the recommendation that eventually they went for, and they decided that a systematic and rational assessment would be a sufficiently precise principle to be adopted in IFRS 17. IFRS 17 disclosure should be sufficient also to facilitate the user's understanding of how an insurance company has gone about setting the approach of recognizing the CSM. The next dimension is about the contract boundary. For VFA contracts, asset management cost should be regarded as part of the cost of fulfilling the contract, and so they are part of the boundary cash flows. Equally, cash flows related to the fulfillment of an investment return service for general model contracts should also be included in determination of coverage units and therefore are within the boundary. When we look at the subsequent measurement, this is where the staff concluded, in my opinion correctly, that the difference between VFA and non-VFA contracts remains in place and must remain in place in a sense that the unlocking of the CSM for the general model must continue to be done without inclusion of financial variables, unless, as we know it, for the so-called indirect participating contracts, the changes in financial variables have actually resulted in a change in the level of discretion that the issuer applies to share the returns from those non-specified underlying items with the policyholder. So other than that, this dimension will actually confirm the difference between VFA and non-VFA contracts. And finally, in terms of eligibility for the PIA, that will have to be adjusted. And now, when you have an investment return service, that service obligation and the duration of that service obligation will have to be considered in terms of whether or not the contract qualifies automatically for the premium allocation approach or doesn't, because it's more than 12 months. So the 12 months limit remains in place, but will be not only for the insurance coverage period, but also for the investment return service. All these indicate to me that there is now a very good basis for this amendment to be put through, and certainly at Deloitte we look forward to see that written down in the exposure draft in a few months' time. The discussion then continued. The staff thought that the recognition of the CSM in profit and loss is, of course, a fundamental aspect of depicting the performance that the insurer provides to the policyholder in a group of insurance contracts. They also acknowledge that there is inevitable subjectivity when the pattern of the provision of service is calculated by an insurance company, and particularly more when there are two key services being provided through the contract. One being the insurance coverage, the other being the investment return service. If you use these two services as the basis for the recognition of the CSM to profit and loss, you will nevertheless provide a more useful information without necessarily introducing more subjectivity by allowing for these other services being counted in the calculation of the coverage units. So all in all, it could be said that the benefits will outweigh the cost of including an investment return service in the determination of the coverage units, and the differences between the general model and the VFA could be reduced for that particular aspect, because the differences in the CSM recognition partner would be reduced. And when there are contracts that have got substantially similar combination of services, barring the difference that remains in place in terms of the unlocking of that CSM, the allocation of the CSM should be done inspired by the same principle. This is an amendment that will have a widespread effect. The staff concluded correctly in that regard. And there is a large number of contracts that will be offering the investment return service presence. However, although it is widespread and therefore it will impact several implementation projects, the staff concluded it can be justified given that more useful information will be made available to the users. And so when the board was called to vote on this proposal, vast majority emerged with 13 votes in favor and only 1 against the staff recommendation to amend the standard. Let me now take you through the second major fix approved in the board meeting last week. That is around acquisition cash flows for renewals, which are outside the contract boundary. We all know that entities pay commissions for new contracts and new customers in particular, where renewals are expected to happen in the future. Commissions, in some cases, are higher than the premium for the first contract because there is a high expectation of a substantially long stream of renewal contracts to follow, and therefore the identification of a new contract that was never part of the customer base of that insurer is rewarded accordingly with a commission that is commensurate to that stream of future renewals. Now, cash flows related to renewals arising from newly issued insurance contracts are always outside the boundary, and therefore they will not be part of the initial recognition of the first contract with the new customer that the insurer will have to report. If you have paid insurance cash flows that include both a component paid at the contract inception, and also you are promising then further payments that are expected to be given to intermediaries within the contract boundary, those cash flows will have to be reflected to the extent that they are refundable. But if there are insurance cash flows that are not refundable, then this creates an even greater problem in terms of the recognition at the initial recognition date, the measurement of the initial recognition date. The other point is that acquisition cash flows are not separate assets in IFRS 17. They are part of the fulfillment cash flows of the group of contracts, and they are therefore treated in the context of the overall measurement of the insurance cash flow, representing faithfully the obligations to pay for insurance losses. If you then look at the measurement that IFRS 17 has got, it does capture already the necessary elements to ensure that any non-recoverable acquisition cost is dealt with properly, either at initial recognition or over time. And so there is no need for a separately test for impairment of such recoverable acquisition cost cash flows if they were recognized in any way, shape or form. Finally, the amount that relates to the acquisition cash flows is allocated to each reporting period in a systematic way on the basis of the passage of time. The same amount is recognized as revenue and insurance service expenses as coverage is provided. The effect of insurance acquisition cash flows on profit is captured in the measurement, and allocation is done in line with the contractual service margin. Given that, the staff recommendation is to put through 5 amendments to resolve the mismatch on the initial recognition of the first contract with a new customer. The first one is to allocate to any anticipated contract renewals part of the insurance acquisition cash flows directly attributable to the newly issued contract for new customers. Second, to recognize the acquisition cash flows allocated to anticipated contract renewals as an asset according to IFRS 17, paragraph 27, where even before this amendment, there was already contemplated the possibility of pre-coverage cash flows arising from non-attributable acquisition cash flows, non-attributable to the individual contract. So that asset was already present, if you like, in the ideal balance sheet coming out of 17, but now paragraph 27 is going to be amended to ensure that these extra cash flows attributable to the single contract are also taken into account in the creation of the pre-coverage asset. The third part of the proposed amendment is that the recoverability of such an asset will be done according to IFRS 17 paragraph 27 in each period before the related contracts expected to be issued are recognized. The recoverability assessment will be based on the expected fulfillment cash flows and the related group of contracts. And so effectively is an estimate of future business against which the recoverability of these assets will have to be done. If there is a loss, that will be recognized in P&L immediately for any unrecoverable amount, again, in the new text of paragraph 27. Equally, if there is a measurement at a subsequent date that indicates that the reversal of such loss is justified, it should be done immediately also through P&L as per normal impairment accounting approaches. With that said, the staff also went on to explain that the requirements of IFRS 17, as amended, will result in the recognition of a loss. But if they are not amended, this loss will be larger, particularly because the entity doesn't have any guarantee of recoverability from the agent, and also because the entity would expect to recover non-refundable commissions from expected contract renewals, and these cash flows relate to contracts that are not from existing substantive rights and obligations. So the loss will be very, very large indeed. That loss, under these circumstances, would be similar to recognizing a loss as a result of significant discount being given to a customer for the first contract being written on anticipation that he will come back and pay more premium without discount by renewing the contract later on. But the economic substance of the transactions may not be reflected from applying these requirements, and IFRS 17 may actually differ for what may be achieved in arguably similar circumstances if IFRS 15 was taken into account. In IFRS 15, the circumstances in paragraph 25, if you were taking 15 as the basis, would actually allow you to recognize an asset for the non-refundable commission part if the entity expect that the non-refundable commission will be amortized over a period during which anticipated renewals of and therefore future profitable contracts will be sold and make this cost effectively a recoverable asset. The IASB staff also noted that they are not really drawing an analogy to IFRS 17 to change IFRS 17 for all aspects surrounding acquisition costs, because in 15 we know that it's only incremental cost of obtaining the contracts that relate to an anticipated contract renewal, and that is not comparable to the requirements in IFRS 17. The staff noted that 17 requirements should be considered in a way that align more closely to 15 requirements nevertheless, but not to make them identical. And so in that context, the staff considered and rejected some other approaches, like full alignment with 15, or the changes in the contract boundary to include more of future inflows, and felt that the only way to do was the one recommended, and produce effectively an amendment to paragraph 27 with a pre-coverage asset being recognized also for directly attributable commissions to the first contract when that commission is paid in anticipation of future contract renewals. That means that all the changes that I mentioned earlier would be introduced in the standard with an amended longer paragraph 27, and here you see recapped effectively the text that was in the blue box in the previous slide. The vote that followed was again a very large majority of 13 board members in favor of the staff recommendation and only one against it. So that's the second of the major fixes that the board approved last week. Let's now move on to the third one. This is about reinsurance contracts held and how to deal with the initial recognition of reinsurance contracts when the underlying insurance contracts are onerous. For our insurance contracts held, the cedent receives a service from reinsurer. The CSM that comes out from the measurement doesn't represent the unearned profit as you would for issued insurance contract. Instead, it represents the net cost or net gain of purchasing reinsurance. So that is a net cost or a net gain, and is recognized over the coverage period as services from the insurer are received by the cedent. There is one exception to this accounting of the CSM, and that is when the insurance contract cash flows are taken direct to P&L because the underlying group of insurance contracts has become onerous after initial recognition due to adverse changes in the estimates of fulfillment cash flows. And those onerous insurance contracts are reinsured by that particular contract. To the extent that there is a corresponding change in the fulfillment cash flows of the insurance contract held, CSM would not be adjusted, and instead the changes in cash flows are recognized in P&L. This is an exception that is being added in response to concerns that were raised with regards to the 2013 exposure draft, and is captured in paragraph 66, letter C, Roman 2. The concern is that such exception is actually too narrow, and allegedly you could interpret the words in 66 C Roman 2 in a way that an accounting mismatch could be produced because the underlying contracts are onerous not subsequently but at the initial recognition, where a loss will be immediately recognized to P&L, and according to that interpretation you may say that the reinsurance contract held would be recognized without having the recovery being put through P&L at the same time as the onerous contract loss is recognized in P&L. The other mismatch would arise when the insurance contract held is in a net cost position and covers both onerous and profitable groups of contracts underneath. So with that, the staff suggests that the board contemplates the amendment of paragraph 66C Roman 2 to require an entity to recognize a gain in profit or loss when the entity recognizes losses on onerous underlying insurance contracts to the extent that the insurance contracts held covers the losses of each contract on a proportionate basis. And then to do the same irrespective of whether the underlying contracts are done by using the general measurement model or the premium allocation approach. This is it's called the immediate loss mitigation solution, which is the only possible amendment that the staff considered to be doable under the criteria approved by the board in October last year, and that results in a change in the accounting for insurance contracts held. The expanded scope of the provision in 66 C Roman 2 would then require the entity to recognize more recoveries in P&L and to leave the net gain or net cost unchanged for that particular instance in the various situations. And the table that is reported in the slide explains the two different regimes before and after amendments. You can see that only the third scenario, the one that you have an underlying group of insurance contracts becoming onerous after initial recognition because of adverse changes in estimate of cash flows at the moment, would trigger clearly in both cases a recovery recognition through P&L for the reinsurance. But when you have an underlying onerous contract group recognized for the first time at initial recognition, allegedly you wouldn't recognize the recovery from reinsurance in P&L, whilst with the amendment that would be the case. And also if you have some further onerous insurance contracts being issued to join the onerous group, in some circumstances you would, in other circumstances you wouldn't. But now with the amendment, that scenario would also result in the same recognition through P&L of the reinsurance recovery. So the staff noted that the accounting mismatch that was identified by the stakeholders could be resolved by making a new requirement to be part of the standard and recognize this gain on an insurance contract held when losses are recognized on the onerous underlying contracts, to the extent that there is a reinsurance contract covering the losses on a proportional basis. And that is an important distinction. If it is non-proportional, the IASB staff explained during the debate, you cannot prove in their opinion that there is a direct linkage between the losses on the onerous contract underlying the insurance contract and the insurance contract itself, and so they would not accept that non-proportional insurance would effectively allow this accounting treatment. So we have to bear this in mind. They gave also a couple of scenarios which I decided to summarize for you in the next slide. Scenario number one is where you have an insurance contract held which is in a net gain position and provides coverage for underlying groups of insurance contracts which are onerous, and the entity issues onerous insurance contracts with a coverage period 2 years and measures the loss at initial recognition as a 200 coverage unit. At the same time, enters into an insurance proportional contract, 50% quota share for those contracts. You can see that according to this interpretation that circulates at the moment in the various circles dealing with IFRS 17, you would have a loss of 150 in year one and a profit of 150 in year two, whilst with the amendment you have a loss of 100 on year one, making maximum recovery out of the insurance protection that you have at the time when the loss is recognized, and then in year two is zero P&L. The second scenario is when an insurance contract held is a net cost position and provides coverage for an underlying group of contracts, one of which is profitable and another one is onerous. The entity in this case issues the insurance contracts with again 2-year periods of coverage. Some of the contracts are expected to be profitable and some are expected to be onerous, so we got two groups, one producing an onerous loss which is 100, and the other one profitable with a CSM of 200. At the same time, you enter in the same 50% quota share in the previous scenario. And you can see here that if you use the current interpretation of 66C Roman 2, you end up recognizing a small loss of 25 on year one and then a profit of 75 on year two. In reality, because the onerous loss is fully reinsured by the treaty, you can get protection of year one, and then you have effectively the cessions of the remaining net profit to the reinsurer, which gets effectively 50% of the net profit of the two groups of 100 being ceded to them. So the net profit is 50 with a reinsurance contract held recovering fully the loss on year one and then capturing the residual net profit of 50 in year two. These are obviously clear examples and they are there to demonstrate the soundness of the recommendation, but you can see that they could hold true also in more complex realistic examples. So this amendment would avoid significant loss of useful information and also not be contrary to the general principles in IFRS that gains should not be recognized before service is provided. The staff thought that the possible disruption that would come from implementation of this new requirement could be justified, given that the feedback that they've already collected from several stakeholders is positive and is likely to produce a volume of benefits for users that is greater than the cost preparers will have to incur. The benefits in particular will expand the existing exception of IFRS 17 and resolve accounting mismatch that currently will be outside the scope of 66C Roman 2, and that will be larger than the cost that the possible amendment would force insurers to incur. They also observe that this approach links the accounting for insurance contracts held to the accounting for the underlying insurance contracts, and that the existing exception already introduced that link. So it's not really bending a principle, it's just making an application of the same principle to perhaps a more appropriate perimeter. Finally, the staff observed that similar accounting mismatch could arise when the underlying insurance contracts are measured applying the PAA, or the insurance contract held is measured applying the PAA, or both. And so to avoid any ambiguity, the staff also recommended that the expanded exception should apply both to contracts measured applying the general model and the PAA. And so the recommendation, as you can see, summarized again, was put to the vote, and in this instance actually was unanimous. All of the 14 board members agreed with the staff recommendation to make the amendment in paragraph 66C Roman 2. Coming then to the fourth and final amendment that was approved last week, staying in the theme of reinsurance contracts held. Here the IASB picked up a topic that was already discussed to some extent in the December meeting around the VFA hedge accounting and what instruments could be used for the execution of the risk management strategy. We know that the standard as it is at the moment allows only derivatives to be used as a hedging instrument. This choice allows entities to avoid accounting mismatches created by the VFA when you are buying derivatives to mitigate the risk that are included in the CSM measurement under VFA. If you modify the VFA to include the insurance contracts held when the underlying insurance contracts are insurance contracts with direct participating features, aiming to avoid a mismatch that would result from the different pattern of CSM recognition between the insurance contract held and the underlying VFA accounted insurance contracts, you could end up in an inconsistent direction to the IASB principle that reinsurance contracts should not be accounted for separately from the underlying insurance contracts that are issued. So instead, the recommendation is to amend IFRS 17 and expand the scope of the risk mitigation exception for insurance contracts with the direct participating features in paragraph B115 of IFRS 17, so that it applies also when the entity uses derivatives or our insurance contract held to mitigate the same financial risk that was debated in December, to the extent that the entity meets all the other conditions set out in paragraph B116. That idea was approved unanimously by the board, but at the same time confirmed that it is only by making eligible as a hedging instrument the insurance contracts held that this would be possible, not by allowing reinsurance contracts to be treated under the VFA. So that prohibition, which is in one particular paragraph of IFRS 17, which was the fifth and final concern discussed last week, did not result in the deletion of that paragraph. So that paragraph remains, and reinsurance contracts will not be allowed to be VFA accounted. But you can designate a reinsurance contract held to be a hedging instrument. In that case, the P&L financial variables that arising from the reinsurance contract accounting can then be used to extract from the unlocking of the CSM of the VFA accounted underlying insurance contracts out of the unlocking calculation into P&L to be matched against the P&L treatment of the changes in financial variables affecting the measurement of the cash flows from the insurance contract held. So that was the final point on the discussion of the different concerns that the IASB went through last week. Let's now talk about the next steps. Next week, they continue with a third batch of concerns. As I mentioned in the highlights, they cover another 4 concerns that were part of the original list, with 2 only left to complete the job, and that will be completed most likely during the March IASB meeting. After that, TRG will meet again on the 4th of April in London, and if you have an interest in having your issues being considered by the TRG, remember that the submission date is Valentine's Day, 14th of February. Earlier submissions are encouraged, of course, to allow the IASB staff to publish the papers earlier for us to read in the TRG. But if not, that is the deadline. So not only for enjoying a Valentine's party with your loved partner, but also to make sure that TIG submission is in your sent box before going out for celebrations. So let's talk about next week then in a bit more detail. I captured the staff recommendations from the various papers that they have tabled, and I just want to give you a brief summary of what they are proposing to do with each of those concerns. The first paper is about concern 1. That is for loans that transfer significant insurance risk, and the proposal is to make an amendment, amending IFRS 17 and IFRS 9 in a way that if there are insurance contracts that produce a settlement of some of the obligations just because of the contract, then entities will be able to choose whether to continue to account for those insurance contracts in IFRS 17 as per normal, or to make an election and account for them under IFRS 9. That is a similar mechanism to the one that exists already for fixed fee service contracts today. The second agenda paper, Transition, Optionality and Comparative, deals with two concerns, number 21 and 23 from the October list. In terms of optionality, the staff recommends not to make any changes and to leave all the optionality as it is at the moment in IFRS 17 for transition. And in terms of comparative information, to retain the IFRS 17 requirements to present restated comparative information. So the concern that suggests that perhaps the burden of the implementation of IFRS 17 could be reduced by avoiding the restatement of comparatives is now being dealt with, and the staff recommends to the board not to remove that requirement. We'll see whether the board agrees with the staff on this proposal, as they've done so far invariably for all of the proposal put to the table in the December and January meetings. Then paper 2C deals with another transition-related concern. This is actually not a new one. Is concern 8 had already been discussed in December, and you remember for the non-transitional part they already reached a decision in December, which led then to another follow-up decision last week on the insurance contracts held. Now they're going to deal with the transition part, and the recommendation here is actually to retain the IFRS 17 requirements that prohibit the retrospective application of the VFA hedge accounting or the risk mitigation option, and also to retain the requirements in IFRS 17 with respect to the cumulative amounts included in other comprehensive income on transition to IFRS 17. There is an associated concern. At the moment, I cannot be certain, based on my own reading of the paper, whether that concern, which is number 25, is actually dealt with in this paper or not. So I still left it as one to be dealt with in terms of the two remaining ones together with the level of aggregation. But we'll see next week on Thursday whether this discussion actually allows them to also deal with concern 25, which is associated with the asset OCI treatment, not the liability, that are related to the fair value approach of transition, not specific to the risk mitigation. That's why at the moment I think that concern actually is still to be dealt with, to be dealt with in a different paper. Finally, the paper that perhaps is the most important of the set, agenda paper 2D, the modified retrospective approach, or MRA, deals with the concern number 24 on how to find some further simplifications to the modified retrospective approach. And here we have a proposed amendment that perhaps is quite targeted. It is effectively amending the requirements in IFRS 17 for a liability that relates to the settlement of claims incurred before an insurance contract was acquired as follows. You add a specified modification to the MRA to require an entity to classify such liabilities as a liability for incurred claims, and permit an entity applying the fair value approach to choose to classify such liabilities as a liability for incurred claims, despite effectively creating the CSM potentially in a normal way. So it is a simplification of some extent. But the other areas perhaps could have been more interesting. Unfortunately, the IASB staff stated that they would like to recommend for the board to retain the requirements of IFRS 17, that an entity cannot use a specified modification in the MRA to the extent that the entity has reasonable and supportable information to apply the related IFRS 17 requirements retrospectively, and retain the requirements that an entity can only use a specified modification in the MRA when the entity has reasonable and supportable information to apply that particular modification. Also, the staff recommend not to amend IFRS 17 to permit an entity to develop its own modifications. Also, not amending the specified modification in the MRA related to the use of cash flows that are known to have occurred, instead of estimating retrospectively cash flows that were expected to occur. And finally, not to amend IFRS 17 to permit an entity to apply the specified modifications related to groups of insurance contracts without direct participation features to determine the CSM for groups of insurance contracts with direct participation features. So a long list, unfortunately, of recommendations not to change IFRS 17, and one that will introduce some simplification. My preliminary analysis would suggest that a number of insurers will probably be disappointed to the limited extent that these recommendations is taking the modified retrospective approach towards a new, more simplified approach of restating the past of insurance contracts accounting. That is the last of my messages, and so as I land on the final slides, I would like to declare the recorded part of the webcast closed and open the floor for any questions.